After nearly 3 years of drought, the US initial public offering market has staged a remarkable comeback. Since early 2025, Wall Street has seen a steady stream of companies returning to the public markets, culminating in what many analysts now call the business IPO season since 2021. This resurgence is not only reshaping capital markets but also revealing much about investors' appetite, sector trends, and the broader financial climate as the Federal Reserve edges closer to a potential interest rate cut. The IPO market, often seen as a barometer of financial confidence, had been in a deep freeze since late 2021. Rising inflation, aggressive interest rate hikes, geopolitical tensions, and volatile equity markets created a toxic environment for new listings. Many high-growth firms, particularly in tech and fintech, postponed or cancelled plans to go public, preferring to remain private until conditions stabilized. By 2022 and 2023, IPO volumes had collapsed at their lowest levels in over a decade. Now, in 2025, the picture has changed dramatically. In just 1 week, this September, seven large IPOs debuted on US exchanges, collectively raising more than $4 billion money. The most active week since the post-pandemic boom years. What makes this revival particularly striking is not just the volume of deals, but their diversity. From fintech unicorns like Klarna to digital assets exchanges like Gemini to consumer-facing firms like BlackRock Coffee, the breadth of sectors returning to market suggests a renewed confidence across industries. Take Klarna, the Swedish buy now pay later fintech giant. Long considered one of Europe's most valuable startups, Klarna finally pressed ahead with its New York IPO after years of speculation. The listing was closely watched not only because of Klarna's size, valued at over $20 billion, but also because of what it symbolized. A European tech champion choosing US capital markets to fund its growth, the IPO priced strongly, with shares rising double digits in early trading, signaling the investor appetite for fintech remains robust despite concerns about regulation and consumer credit risks. Meanwhile, Gemini, the cryptocurrency exchange founded by the Winklevoss twins, also made headlines with their IPOs. The crypto sector has endured brutal swings since the collapse of FTX in 2022, and the success of Gemini's offering is seen by many as a litmus test for whether digital assets are regaining credibility in mainstream finance, while some investors remain wary. The oversubscription of the deal reflected optimism that regulated crypto firms can carve out a sustainable business model in the evolving digital asset landscape. Smaller but no less symbolic listings also grabbed attention. Figure Technology Solutions, a blockchain-based lending platform, and BlackRock Coffee Bar, a consumer retail chain, both enjoyed first days pops of 28% to 38%. Such gains harken back to the heady IPO markets of the late 2010s, when strong debuts were celebrated as proof of investor enthusiasm. Yet, seasoned analysts warn that early surges can just as easily deflate once the lock-up period ends and insiders are free to sell shares. So why now? Several forces are converging to fuel the IPO revival. First, interest rate expectations have shifted. With inflation moderating and the US labor market showing signs of cooling, markets increasingly anticipate that the Federal Reserve will begin cutting rates in late 2025. Lower borrowing costs support higher valuations, particularly for growth companies whose business models rely on future cash flows. The mere expectations of easier monetary policy has been enough to reopen the IPO window. Second, pent-up supply is finally being released. Companies that delayed listings during the volatile years of 2022-2024 are now seizing the opportunity to raise capital before valuations potentially decline again. Many of these firms face pressure from early investors and venture capital backers eager to exit, creating a natural wave of IPO candidates. Third, the equality market backdrop has improved. The S&P 500 remains near a record high, powered by enthusiasm for artificial intelligence, resilient corporate earnings, and strong retail participation. Investor sentiment, though cautious, is far more constructive than it was 2 years ago. IPOs thrive in such environments because buyers are more willing to take on risk. Of course, risks remain. The specter of inflation still hangs over the US economy. A reacceleration in prices could derail Fed rate cut plans and quickly soar equity markets. Geopolitical tensions from trade disputes to global conflicts also inject volatility. Moreover, some skeptics argue that the current wave of IPOs may be more about insiders cashing out as high valuations than about genuine long-term growth opportunities. Another concern is sector concentration. While the current revival features more variety than the 2021 tech-heavy boom, many of the market's deals are still clustered in fintech, digital assets, and consumer tech industries vulnerable to regulatory shifts and certain consumer trends. If one high-profile IPO underperforms dramatically, it could chill investor appetite across the board. Yes, despite these warnings, the mood on Wall Street is noticeably more optimistic. The fact that multiple IPOs can price successfully in the same week, and in some cases trade higher afterwards, suggests that institutional investors, hedge funds, and retail buyers alike are ready to re-engage with their listings. Looking ahead, analysts expect the momentum to continue into late 2025 and early 2026. Pipeline companies rumored to be eyeing the eye include Stripe, Databricks, and Reddit, all of which have been long awaited by investors. If these firms choose to move forward, it could solidify 2025 as the year the IPO market finally regained its stride. In the broader scheme, the IPO revival carries symbolic weight. It reflects not just the recovery of capital markets, but also a renewed belief in innovation and growth. After years of caution, investors are once again willing to fund the next generation of disruptive companies. Whether this enthusiasm proves sustainable will depend on macroeconomic stability, monetary policy, and whether these newly public firms can deliver on their promises. For now, though, Wall Street has rediscovered something it has sorely missed: the excitement of the IPO bell ringing, the spectator of its first day surge, and the belief, however fragile, that tomorrow's giants are being born today.